Hello everyone, welcome back to Swadhyay. Today, let us discuss few illustrations from the topic income from house properties. In the last video, we have completed discussing the concepts which are related to the head income from house properties, and now we are going to solve 6 illustrations which have been given in our institute material. Before heading for the problems, let us once revise a small concept, that is computation of income from house property. For any house property in any case, first, while computing the income from house property, we have to compute gross annual value. This is the first step. The second step is we have to deduct municipal taxes so that we will arrive at a value called net annual value. Then we have to provide for deductions under section 24. The first deduction is under section 24A, that is standard deduction at the rate of 30% of net annual value. The second deduction is under section 24B, that is interest on borrowed capital. After providing for these deductions, we arrive at the value which is income from house property. Now let us discuss the first question. The first case is regarding the house property which has been let out throughout the previous year. Mr. A has a property whose municipal valuation is rupees 1,30,000. Fair rent is rupees 1,10,000 per annum. Standard rent is rupees 1,20,000 per annum, and it is let out for a rent of rupees 11,000 per month throughout the previous year. The unrealized rent was rupees 11,000 and all conditions prescribed by the Rule 4 are satisfied. He paid municipal taxes at 10% of municipal valuation. Interest on borrowed capital was rupees 40,000 for the year. Compute his income from house property for the assessment year 2024-25. Heading to the solution. We know that while computation of gross annual value, that is the first step in computation of income of house property, we take the value which is higher of municipal valuation or fair rental value, but such value will be restricted to standard rent. It is called expected rent. The expected rent is higher of municipal valuation or fair rent, which is restricted to standard rent. Here, the municipal valuation is rupees 1,30,000 per annum and fair rent is rupees 1,10,000 per annum. We choose the higher value between these both, that is rupees 1,30,000 per annum. The standard rent is rupees 1,20,000 per annum. Comparing rupees 1,30,000 to 1,20,000, the lowest one is the standard rent, rupees 1,20,000 per annum, which is our expected rent in the case. The actual rent. The property is let out for rupees 11,000 per month throughout the previous year, but the unrealized rent was rupees 11,000 and all the conditions prescribed by the Rule 4 are satisfied. Hence, we are multiplying this 11,000 per month into rupees 12. That is, we are arriving at a actual rent which has been paid, which is payable for whole year. 11,000 into 12 months, but we are deducting rupees 11,000 unrealized rent. We arrive at the value rupees 1,21,000, which is our actual rent. Gross annual value is higher of expected rent or actual rent. So the gross annual value is higher of 1,20,000 and 1,21,000, that is 1,21,000. Now the second step is we have to deduct municipal taxes. The municipal taxes, as given in the question, are paid at the rate of 10% of municipal valuation. The municipal valuation is rupees 1,30,000 per annum and 10% of rupees 1,30,000 is rupees 13,000. This 13,000 is being deducted from our GAV. We arrive at net annual value of rupees 1,08,000. The third step, we are providing for deductions under section 24. The first deduction is standard rent at the rate of standard deduction at the rate of 30% of net annual value. That is 30% of rupees 1,08,000, which equals to rupees 32,400. Now we have to provide for interest on borrowed capital under section 24B. The interest on borrowed capital was rupees 40,000 for the year. So we have taken rupees 40,000 as a whole amount. Since it is satisfying the condition of threshold limits, we are taking 40,000 the whole amount as deduction under section 24B. Under section 24, the total amount of deduction is rupees 72,400. We are deducting it from the net annual value 1,08,000. Hence, the income from house property is rupees 35,600. The two important points we have to remember from this question are, the first one is when there is unrealized rent which is satisfying all the conditions prescribed by Rule 4. We are not going to consider such amount in our actual rent amount. The second point is the interest on borrowed capital. Since this is the case where the property is let out for whole previous year, throughout the previous year, there are no complications for deduction under section 24B. And so we have taken the whole amount of interest on borrowed capital, that is 40,000, as a deduction under section 24B, and we have reduced such amount from the net annual value. For let out property, there is no threshold limit for taking deduction under section 24B. Heading to our next question. Heading to the second problem, the case is where the house property is let out but it is vacant for a part of year. Mr. G owns a house property whose fair rent is rupees 2 lakh per annum. The municipal valuation is rupees 2,50,000 per annum. Standard rent is rupees 2,10,000 per annum. It is let out for a rent of rupees 20,000 per month. However, the tenant vacated the property on 31st January 2024. So the tenant has stayed in the house property in the previous year for only 10 months. The unrealized rent was rupees 20,000 and all conditions prescribed by Rule 4 are satisfied. He paid municipal taxes at the rate of 8% of municipal valuation. Interest on borrowed capital was rupees 65,000 for the year. Compute the income from house property of Mr. G for assessment year 2024-25. The first step in computation of income from house property, that is computation of GAV. GAV is higher of expected rent or annual rent. Here the expected rent is higher of municipal value or fair rental value, that is higher of rupees 2 lakh or 2,50,000 per annum. The higher value is rupees 2,50,000 and it is restricted to standard rent. The standard rent is rupees 2,10,000 per annum. So our expected rent in this case is rupees 2,10,000. Next point, the actual rent. The tenant has stayed in the property for 10 months only. Rent per month is rupees 20,000. So 20,000 rupees into 10 months minus 20,000 being the unrealized rent. We are deducting unrealized rent portion also, that is rupees 20,000, because the conditions prescribed by the Rule 4 are satisfied. So the actual rent stands at rupees 1,80,000. We know that GAV is higher of expected rent or annual rent. But since the actual rent is less than expected rent owing to the vacancy, we consider actual rent received as gross annual value. That is, if the property is not vacant for 2 more months, then our actual rent would be rupees 1,80,000 plus 20,000 per month into 2 months. That is, our actual rent would be 2,20,000, which is higher than the expected rent. Owing to the vacancy only, actual rent is less in our case. So we are considering if the house property has been let out for 2 more months also, instead of being vacant, then it would fetch us 40,000 more rent. Then the actual rent would be higher than expected rent. Hence, in this case, we take gross annual value as 1,80,000, that is the actual rent received by the owner. Instead of taking the highest value among the expected rent or annual rent, since the house property is fetching less rent due to vacancy of the house property being unoccupied, we are considering the actual rent only as our GAV in this case. So gross annual value of the house property stands at rupees 1,80,000. The next step, deduction of municipal taxes. The municipal taxes are paid at the rate of 8% of municipal valuation. Municipal valuation is rupees 2,50,000 per annum. So 8% of 2,50,000. So 8% of, I think there is a mistake in the material here. 8% of municipal valuation, 2,50,000 is rupees 20,000. After deducting 20,000 municipal taxes from 1,80,000, that is the gross annual value, we arrive at net annual value of rupees 1,60,000. Providing for deductions under section 24, our third step in computation of income. The first deduction under section 24 is 24A, standard deduction at the rate of 30% of NAV. Our NAV is 1,60,000 and 30% of NAV, the standard deduction stands at rupees 48,000. The interest on borrowed capital is rupees 65,000. So, under section 24B, we are deducting the amount of rupees 65,000, which has no ceiling limit because the property is let out property. There is no ceiling limit on section on claiming the deduction of rupees 65,000. The total deductions under section 24 stands at rupees 1,13,000. Deducting rupees 1,13,000 deductions from the net annual value, which is rupees 1,60,000, we arrive at income from house property being rupees 47,000. So the income from the house property of Mr. G for the assessment year 2024-25 is rupees 47,000. Heading to our third case, that is house property is self-occupied or unoccupied. Purna has one house property occupied by her and her family. The owner is occupying the house property. The fair rent is rupees 25,000 per month. Municipal valuation is rupees 2,80,000 per annum and municipal taxes paid is rupees 8,000. The house construction began in April 2017 with a loan of rupees 20 lakh taken with interest at 9% per annum on 1st April 2017. The construction was completed on 30th November 2019. The accumulated interest up to rupees 31 March 2019 is rupees 3,60,000. On 31st March 2024, Purna paid rupees 2,40,000, which included rupees 1,80,000 as interest for the previous year. There was no principal repayment prior to this date. Compute Purna's income from the house property for the assessment year 2024-25, assuming that she has exercised the option of shifting out of the default tax regime provided under section 115 BAC. Since the house property is self-occupied, we take gross annual value as nil, hence our net annual value of the house property is also nil. The annual value of house used for self-occupation will be nil. From this, we have to provide only deductions under section 24. We cannot deduct, we cannot claim standard deduction at the rate of 30%. So, we can only claim the deduction under section 24B, that is interest on borrowed capital. In the question, it is given that the loan amount is rupees 20 lakh, the interest is 9% per annum, and the accumulated interest up to 31st March 2019. That is the year prior to the year in which the construction has been completed. The construction was completed in the financial year 2019-20. The accumulated interest up to the financial up to the year 2019, 31st March 2019 is 3,60,000. This will serve as the pre-construction period interest. On 31st March 2024, Purna paid rupees 2,40,000, out of which rupees 1,80,000 is interest. And before this, there is no principal repayment. That means in the previous year, 2023-24, Purna has paid rupees 1,80,000 as interest on borrowed capital. So, First, we straightforward claim rupees 1,80,000, the interest which has been paid in the previous year as deduction under section 24. Interest on loan taken for the construction paid in the previous year is rupees 1,80,000. To this, we also add pre-construction period interest. The accumulated pre-construction period interest is rupees 3,60,000. But as per the income tax provisions, we can claim only 1/5 of pre-construction period interest for the next 5 years after the completion of construction. So, 1/5 of rupees 3,60,000 is rupees 72,000. Total deduction under section 24 is rupees 2,52,000, including the interest amount which has been paid in the previous year as well as pre-construction period interest. The total interest amount stands at rupees 2,52,000. But the interest is allowed up to maximum amount of rupees 2 lakh only for self-occupied property. We know that under the optional tax regime, if the property is self-occupied, we have a ceiling limit of rupees 2 lakh only to claim the deduction under section 24B. So, Purna can claim only rupees 2 lakh as deduction under section 24B. Since the net annual value is nil, the loss from house property, not income, the loss from house property will stand at rupees 2 lakh for Purna for the assessment year 2024-25. Heading to our next case, the fourth case, where the house property is let out for part of the year for any tenant and it is self-occupied by owner for part of the year. Srimati Rajalakshmi owns a house property at Adyar in Chennai. The fair rent is rupees 4,20,000 per annum. Municipal valuation is rupees 5 lakh. Standard rent is rupees 4,80,000. Property was let out for rupees 50,000 per month up to December 2023. For 9 months, the property has been let out. Thereafter, the tenant vacated the property and Srimati Rajalakshmi used the house for self-occupation. Rent for the months of November and December 2023 could not be realized in spite of the owner's efforts. All the conditions prescribed under Rule 4 are satisfied. She paid municipal taxes at 12% during the year. She had paid interest of rupees 25,000 during the year for amount borrowed for repairs for the house property. Computer income from the house property for the assessment year 2024-25. The first step is computation of GAV. The expected rent is higher of municipal valuation or fair rental value restricted to standard rent. Here, the higher of fair rent or municipal valuation is rupees 5 lakh, that is municipal valuation, and it is restricted to standard rent being rupees 4,80,000. So, our expected rent will stand at rupees 4,80,000. Computing actual rent. The property has been occupied for 9 months by the tenant. From the April to December, 9 months, it has been occupied by the tenant. After that, for 3 months, Rajalakshmi has self-occupied the house property. So, we compute the actual rent for 9 months, that is 50,000 into 9 months, and we have to deduct unrealized portion of rent. Here it is mentioned that for 2 months, November and December 2023, the rent could not be realized in spite of the efforts of owner. And all conditions prescribed under the Rule 4 are satisfied. So, we have to deduct unrealized rent portion from the actual rent. The actual rent stands at rupees 3,50,000. Here, the actual rent is less than expected rent, but not owing to the vacancy of the property. If Rajalakshmi has let out the property for 3 more months, the house property could fetch more rent than the expected rent. But since she self-occupied the property, the actual rent stands at rupees 3,50,000 only, and the expected rent is higher than the actual rent, that is rupees 4,80,000. So we consider gross annual value as rupees 4,80,000. The second step, deduction of municipal taxes. The municipal taxes are paid at 12% of municipal valuation, that is rupees 5 lakh. So, the municipal taxes are 12% of rupees 5 lakh, that is rupees 60,000. After deducting 60,000 from the gross annual value of rupees 4,80,000, our net annual value stands at rupees 4,20,000. From this, we provide for deductions under section 24. The first deduction under section 24A, that is standard deduction at the rate of 30% of NAV, is rupees 1,26,000. 30% of rupees 4,20,000 is rupees 1,26,000. The second deduction, the interest on borrowed capital. Here, the interest is paid, the interest of rupees 25,000 is paid for the loan, the amount borrowed for repairs of the house property. For repairs of house property, we can claim the deduction up to rupees 30,000 if the property is self-occupied. Here, for repairs, renewals or reconstruction, the actual interest paid for one or two self-occupied properties is maximum rupees 30,000, and for let out property there is no ceiling limit on interest on borrowed property. Since the amount in our case, in the case of Srimati Rajalakshmi, is rupees 25,000 only, we can claim the whole amount of interest on borrowed capital, that is rupees 25,000, as deduction under section 24B. So, our deductions under section 24 stand at rupees 1,51,000. After deducting the amount from rupees 4,20,000, that is the net annual value, we arrive at income of the house property, that is rupees 2,69,000. So, the income from the house property of Srimati Rajalakshmi for the assessment year 2024-25 is rupees 2,69,000. Heading to the next case, where the house property, a portion has been let out and a portion has been self-occupied by the owner. Prem owns a house in Madras. During the previous year 2023-24, 2/3 portion of the house was self-occupied and 1/3 portion was let out for residential purposes at a rent of rupees 8,000 per month. Here Prem is occupying 2/3 portion of the house property. He is the owner of the house and 1/3 portion was let out for a rent of rupees 8,000 per month. The fair rent is rupees 2,70,000 per annum. Municipal valuation is rupees 3 lakh and standard rent is rupees 3,30,000 per annum. He paid municipal taxes at the rate of 10% of municipal value during the year. A loan of rupees 25 lakh was taken by him during the year 2019 for acquiring the property. Interest on the loan paid during the previous year 2023-24 was rupees 1,20,000. In the year 2019, he has availed of loan rupees 25 lakh. The interest on loan paid during the previous year 2023-24 was rupees 1,20,000. Compute Prem's income from the house property for the assessment year 2024-25, assuming that he has exercised the option of shifting out of the default tax regime provided under section 115 BAC. That is, he has chosen to pay tax under the normal provisions of the Income Tax Act. What would be Prem's income from the house property under the default tax regime? Here, the question is asking us to compute the income from the house property under section 115 BAC, the default tax regime, as well as the optional tax regime, that is as per the normal provisions of Income Tax Act. So, to solve this question, since the house property has been partly self-occupied and partly let out, we have to consider we have to break the same house property into two portions. The first unit is self-occupied unit. It is 2/3 area occupied by the owner, and we know that the gross annual value of any self-occupied property will be nil. Automatically, the net annual value of any house property which has been self-occupied by the owner is nil. From this, we can avail of deduction under section 24B only. We cannot claim standard deduction. So, for unit 1, that is 2/3 portion of the house property occupied by the owner, the deduction can be availed, the deduction under section 24B, that is the interest on borrowed capital, can be availed up to 2/3 portion only. Proportionately, we will deduct the interest on borrowed capital under the self-occupied portion and under the let-out portion. So first, for self-occupied portion, 2/3 of rupees 1,20,000 can be deducted under the unit 1. That is rupees 80,000 can be deducted under section 24B. Since first we are considering the case where Prem is paying the tax under optional tax regime. He is opting out of default tax regime. He can claim deduction under section 24B. The ceiling limit is rupees 2 lakh only for self-occupied property. But the interest on borrowed capital is 1,20,000 only. So here we can take 2/3 portion. Proportionately, we can take out of 1,20,000 interest on borrowed capital, we are taking the deduction of rupees 80,000 only for the self-occupied portion of the house property. Hence, the loss from, it is not income, the loss from self-occupied property, self-occupied portion of the house property will be minus 80,000 rupees. Unit 2 is let-out property. Its area is 1/3 of total house property, and for that we can compute gross annual value. We know that expected rent is higher of municipal valuation and fair rental value but restricted to standard rent. The standard rent is rupees 1,10,000. The fair rent is 2,70,000 and municipal valuation 3 lakh. Higher of these both is 3 lakh rupees. Out of this, we have to take the lowest value. The standard rent is 3,30,000. So we consider rupees 3 lakh as the expected rent. But out of rupees 3 lakh, here since the house we are computing the income for only 1/3 of the house property, that is let out portion. We have to multiply rupees 3 lakh with rupees with 1/3. Hence, expected rent will be 1/3 of rupees 3 lakh, that is rupees 1 lakh. Expected rent will be rupees 1 lakh. Coming to the actual rent. The actual rent is paid rupees 8,000 per month. So 8,000 into 12 months is rupees 96,000. Here we are not apportioning the rent since the let out portion 1/3, the rent is paid by the tenant. The rent of rupees 8,000 is paid by the tenant for only 1/3 portion. So there is no need to proportionately take the actual rental value. We simply multiply rupees 8,000 to 12 months, that is rupees 96,000. The expected rent is rupees 1 lakh and the actual rent is rupees 96,000. GAV is higher of expected rent or annual rent. So the gross annual value will be rupees 1 lakh. That is the expected rent. From this, we have to deduct municipal taxes. The municipal taxes are paid at 10% of municipal valuation. The municipal valuation is rupees 3 lakh per annum. It means 10% of rupees 3 lakh is rupees 30,000. But the let out portion is only 1/3 of total house property. Out of total house property, the let out portion is 1/3 only. So we multiply this 30,000 with 1/3, 1/3. That is, the municipal taxes deducted from the let out property's income are rupees 10,000. From the GAV, rupees 1 lakh, we are deducting municipal taxes rupees 10,000. So the net annual value will stand at rupees 90,000. Out of this, we are providing for deductions under section 24. The standard deduction at the rate of 30% of NAV, that is, out of 90,000, 30% is rupees 27,000. So our standard deduction under section 24A will be 27,000, and interest on borrowed capital can be claimed up to only 1/3 portion only. The total interest on borrowed capital is rupees 1,20,000. For let out properties, 1/3 of this capital can be claimed under section 24B as deduction. So rupees 40,000 is interest on borrowed capital, which can be claimed as deduction under section 24B. The total amount of deductions under section 24 will stand at rupees 67,000. We are deducting rupees 67,000 deductions from the net annual value of the house property, that is rupees 90,000. So the income from let out property is rupees 23,000. the loss from self-occupied property is rupees 80,000. From the same house property, since it has been self-occupied partly and let out partly, we have a loss of rupees 80,000, which can be set off with the income from the house property, which is from the let out portion, which is standing at rupees 23,000. Overall, by adding these two amounts, we get a loss under the head income from house property of rupees 57,000. So, if Prem has decided to opt for to pay the tax under the normal provisions of the Income Tax Act, he has opted out of the default tax regime. In that case, the loss from the house property, which has been partly self-occupied and partly let out, will be rupees 57,000 for the assessment year 2024-25. Under the default tax regime, interest deduction of rupees 80,000 cannot be claimed under section 24B in respect of self-occupied portion. In the same calculation, if we consider Mr. Prem is paying the tax under the default tax regime. In such a case, for the self-occupied portion of the house property, he cannot claim deduction under section 24B. It has been stated under the provisions of section 115 BAC that if a person is paying tax under default tax regime, he cannot claim deduction under section 24B, that is interest from the borrowed capital for the house property. So, for the self-occupied portion, that is 2/3 area of the house property, the GAV is nil, NAV is nil, and also he cannot claim any deduction. There will be no income from self-occupied portion and there will be no loss from such self-occupied portion. So, under the default tax regime, the interest deduction of rupees 80,000 cannot be claimed under section 24B in respect of self-occupied portion. There is no income from self-occupied portion. There is no loss from self-occupied portion. But if the same property has been let out, the 1/3 portion has been let out, there will be similar calculations under the default tax regime too. The calculations are similar under the default tax regime too. The only change will be at the interest on borrowed capital under section 24B. There will be a ceiling limit of rupees 2 lakh. But since the interest on borrowed capital is standing at rupees 40,000 only, that is the total amount is 1,20,000 interest on borrowed capital, of which the 1/3 portion which has been let out will claim only 1/3 portion of the interest on borrowed capital, that is 40,000 only. We will get the same income from the let out property under both the regimes, under optional tax regime and as well as default tax regime. So, the income from house property would be rupees 23,000 from the let out portion. Under the if Mr. Prem has opted out of default tax regime, he has incurred the loss under the head income from house property of rupees 57,000. But if he is paying tax under the default tax regime, there will be no income or no loss from the self-occupied portion, and there will be income from the let out portion of the house property of rupees 23,000 if he is paying tax under the default tax regime. The next case is regarding co-ownership. There is a co-owned house property and how we are going to compute the income from such co-owned properties. Two brothers, A and B, are co-owners of a house property with equal share. The property was constructed during the financial year 2015-2016. The property consists of 8 identical units and is situated at Cochin. During the financial year 2023-24, each co-owner occupied 1 unit for residence and the balance of 6 units were let out at a rent of rupees 12,000 per month per unit. Here there are total of 8 units. Out of such 8 identical units, 2 of them are self-occupied by the owners, each one of them. A has occupied unit 1, B has occupied unit 2, and other 6 units were let out for a rent of rupees 12,000 per month per unit. The municipal value of the house property is rupees 9 lakh and the municipal taxes are 20% of municipal value, which were paid during the year. The other expenses were as follows: repairs rupees 40,000, insurance premium paid rupees 15,000, interest payable on loan taken for construction of the house rupees 3 lakh. One of the let out units remained vacant for 4 months during the year. A could not occupy his unit for 6 months as he was transferred to Chennai. He does not own any other house. The other incomes of Mr. A and Mr. B are rupees 2,90,000 and rupees 1,80,000 respectively. Mr. A's other income is rupees 2,90,000 and Mr. B's other income is rupees 1,80,000. Compute the income under the head income from house property and the total income of two brothers for the assessment year 2024-25 if they pay tax under the default tax regime under section 115 BAC. Also, show the computation of income under this head if they both exercised the option of shifting out of the default tax regime provided under the section 115 BAC. So, in case of co-ownership, we have to consider the house property is owned by only one person. Then we have to compute the income from such house property. Either if it is let out or self-occupied, we have to compute the income or loss from the house property as if the house property is owned by one single person. Then, after arriving at the income or loss from the house property, we will apportion such income among the co-owners. First, let us compute the income from the house property for let out portion only. Out of 8 identical units, 6 of them are let out. That means 75% of house property is let out to tenants. The gross annual value computation. Expected rent is higher of municipal valuation and fair rent but restricted to standard rent. The municipal value of the house property is rupees 9 lakh. Here they have not given the standard rent and fair rental value. So we consider municipal valuation as the expected rent. Since the let out portion is 75% of the total house property, we take only 75% of 9 lakh as expected rent. 75% of 9 lakh is rupees 6 lakh 75,000. Computation of actual rent. The actual rent is each unit has been let out for a rent of rupees 12,000 per month per unit. So 12,000 into 6 units into 12 months minus unrealized rent portion. Here it has been mentioned that one of the let out units remained vacant for 4 months during the year. So 12,000 is the rental value which is of one unit, and for 4 months it has been left vacant. So 12,000 into 6 units into 12 months minus rupees 12,000 into 1 unit into 4 months. That is rupees 8,64,000 minus 48,000 is rupees 8,16,000. Rupees 8,16,000 is the actual rental value. The expected rent is rupees 6,75,000. We take gross annual value as the higher value of expected rent and annual rent. In our case, the gross annual value will stand at rupees 8,16,000. The second step, deduction of municipal taxes. The municipal taxes has been paid at the rate of 20% of municipal value. We consider 75% of municipal taxes paid for the purpose of deduction. For the let out portion, we are taking only 75% of actual municipal taxes paid, that is 20% of rupees 9 lakh into 75%. For let out portion, the owners have paid municipal taxes of rupees 1,35,000. After deducting such amount from gross annual value, we arrive at net annual value, which stands at rupees 6,81,000. From this, the third step is providing deductions under section 24. Under section 24A, we provide standard deduction at the rate of 30% per annum, 30% from NAV. That is, the NAV is standing at rupees 6,81,000. 30% of 6,81,000 is 2,04,300. Section 24B deduction. the interest on borrowed capital. Here it has been mentioned that interest on borrowed capital is rupees 3 lakh. Out of this 3 lakh, 75% belongs to the let out portion. 75% of borrowed capital, interest on borrowed capital, belongs to the let out portion of the house, total house property, the whole house property. So 75% of 3 lakh is rupees 2 lakh 25,000, which can be deducted under section 24B for the purpose of computation of income from let out portion of the house property. Total deductions under section 24 are rupees 4,29,300. Deducting this amount from net annual value rupees 6,81,000, we arrive at income from let out portion of a house property rupees 2,51,700. The share of each co-owner is 50%. So Mr. A gets the income from the let out portion of the house property of rupees 1,25,850. Similarly, Mr. B gets the share of income from let out portion of the house property rupees 1,25,850. Equally, they share the income which has been arising out of the let out portion of the house property. If A and B choose to pay tax under section 115 BAC. Under section 115 BAC, we know that we cannot claim deduction under section 24B. So, while computing the income from self-occupied portion of house property under default tax regime, we have net annual value as nil. Of that, we cannot claim standard deduction at the rate of 30%. Under section 24B, we cannot claim the deduction for interest on borrowed capital. So, we neither get any loss or any income from self-occupied property. Either in the case of Mr. A or Mr. B, when the property is self-occupied and they are paying tax under section 115 BAC under the default tax regime, they will not get any income nor any loss. They will not incur any loss. So, the annual value is nil. Deduction under section 24B is nil, and loss from the house property is also nil. There is neither income nor loss. The let out portion. The income from let out portion stands at rupees 1,25,850 and 1,25,850 for both the co-owners. The other incomes of the co-owners as given in the question are 2,90,000 and 1,80,000 respectively. So the total income of A and B, if they want to pay tax under default tax regime, will stand at rupees 4,15,850 of Mr. A, and total income of Mr. B is rupees 3,05,850. If A and B choose to pay tax under optional tax regime, for optional tax regime, A and B can claim a deduction under section 24B for the interest on borrowed capital. 75% of interest on borrowed capital has been already claimed as deduction under section 24B for the let out portion. Here we have to claim only 25%. The total amount is rupees 3 lakh. The total interest payable on loan taken for construction is rupees 3 lakh. Out of this, 25% can be claimed as deduction by Mr. A and Mr. B. Out of the 25%, Mr. A pays 50% and Mr. A can claim 50%, Mr. B can claim 50%. So, 25% of 1,50,000. Here I have bifurcated the loan amount, that is out of 3 lakh, 1,50,000 belongs to A and 1,50,000 belongs to B. Out of 3 lakh interest on borrowed capital, 1,50,000 can be availed by A, 1,50,000 can be availed by B. Out of that, only 25% portion can be claimed as deduction under section 24B for self-occupied portion. The amount stands at rupees 37,500 for each of them, A and B. The loss from self-occupied house property will stand at minus 37,500 for both A and B respectively. The let out portion, which is 75%, it is fetching income of rupees 1,25,850 for each of them. We have computed it above. So if we take the income from house property for Mr. A, out of 1,25,850, he can claim the loss from self-occupied portion of the house property 37,500. So the income from house property of Mr. A stands at 88,350. Similarly for Mr. B, his share of income from let out portion is rupees 1,25,850. And loss from self-occupied portion of house property is rupees 37,500. So the income from house property of Mr. B is rupees 88,350. The other incomes of A and B are rupees 2,90,000 and 1,80,000 respectively. If we add the income from house property and other incomes, the total income of Mr. A and Mr. B for the assessment year 2024-25 stands at rupees 3,78,350 and rupees 2,68,350 for A and B respectively. Here we have to remember one point, that is, in question it has been given A could not occupy his unit for 6 months as he was transferred to Chennai. He does not own any other house. The property is not occupied by A for 6 months, and also it has not been let out for the 6 months. So we still consider that A is in occupation of such property. For computation purposes, for computation of income from the house property, Mr. A has been transferred and he cannot occupy such his portion for 6 months. And also it has been not given for rent for any other tenant. So there is no income from such property, and hence we assume that property has been unoccupied property, and we take GAV as nil for such self-occupied portion for the whole year. Heading for the next case. Deemed to be let out house property. Ganesh has 3 houses, all of which are self-occupied. That means here Mr. Ganesh is holding 3 properties and none of the property has been given for rent. The particulars of the houses for the previous year 2023-24 are as under. The municipal valuation per annum, fair rental value, standard rents, date of completion or purchase of the house property, municipal taxes paid during the year, interest on money borrowed for the repair of the property during the current year, rupees 55,000 for house number 2, and interest for current year on money borrowed in April 2016 for purchase of property, house property 3. The details of each house has been given. For house number 1, there is neither interest on money borrowed for the purpose of acquisition or construction or for the purpose of repair, renewal or reconstruction. But for house number 2, Mr. Ganesh has borrowed money for the purpose of repair of the property, and for house number 3, for the purchase of the property, he has borrowed money. Compute Ganesh income from the house property for assessment year 2024-25 and suggest which houses should be opted by Ganesh to be assessed as self-occupied so that his tax liability is minimum. Heading to the solution. Computation of income from house property of Mr. Ganesh for the assessment year 2024-25. Here, none of the property has been given for let out. It has been not given for rent. So, we cannot derive actual rent received or receivable value. For the purpose of computation of gross annual value, we will directly consider expected rent as the gross annual value of the house property. Since none of the property is let out, there is no actual rent received and we are considering the expected rent as the gross annual value. How to compute expected rent? It is higher of municipal value or fair rental value but restricted to standard rent. Here for the house number 1, the higher of municipal value and fair rental value is rupees 3,75,000, which is restricted to standard rent, that is rupees 3,50,000. So the GAV of house number 1 is rupees 3,50,000. For house number 2, higher of municipal value and fair rental value is 3,60,000. It is restricted by standard rent. The lower of 3,60,000 and standard rent rupees 3,70,000 is rupees 3,60,000. So the GAV for house number 2 is rupees 3,60,000. For house property 3, higher of municipal value and fair rental value is rupees 3,80,000. The standard rent is rupees 3,75,000. So the GAV will be rupees 3,75,000 for house property 3. The next step is deduction of municipal taxes. Municipal taxes paid during the year for house number 1 is 12% of rupees 3 lakh, that is 36,000. For house number 2, it is 8% of municipal value, that is 3,60,000, 28,800. And for house number 3, it is 6% of municipal value, rupees 3,30,000, that is 19,800. I hope you all remember this point, that municipal taxes are paid as per the municipal valuation, that is, if municipal tax is given as a percentage, it will be as a percentage of municipal valuation of the house. After deducting municipal taxes, we have arrived at net annual value of each house property. For house property number 1, NAV is 3,14,000. For house property 2, it is 3,31,200. And for house property 3, NAV is 3,55,200. Providing for deductions under section 24, that is our third step. Deduction under section 24A, that is standard deduction, is 30% of NAV. So 30% of 3,14,000 is 94,200. 30% of 3,31,200 is 99,360, and 30% of 3,55,200 is 1,06,560. These are provided as deductions under section 24A, the standard deductions. The next deduction is interest on borrowed capital. For house property number 1, there is no borrowed capital, either for A or C or RRR. For house property 2, there is a deduction. The interest on money borrowed for repair of property during the current year is rupees 55,000. So for house property 2, we can claim the deduction of rupees 55,000. Here, we are first computing the income as per the optional tax regime. Then we will switch to default tax regime. So, coming to the house property 3, the interest for current year on money borrowed in April 2016 for the purchase of property is rupees 1,75,000. Let us consider each of the properties let out. So, we are providing for deductions under section 24B. The income from house properties will stand for house property 1 as rupees 2,19,800, for house property 2 1,76,840, and for house property 3 it is 73,640. After computation of GAV, after deduction of municipal taxes, we will arrive at net annual value, and after providing for deductions under section 24A and 24B, we arrive at income from house property for each of the house property. Here we are assuming each of the properties let out. That is why we are not taking GAV as nil. Now, we know that an assessee can claim any two of the house properties he is holding as the self-occupied properties. He should treat any two of the properties, house properties, as self-occupied, and any other properties the assessee is holding will be deemed to be treated as let-out property as per the income tax law. So, in the case of Mr. Ganesh can opt to treat any two of the above house properties as self-occupied if Mr. Ganesh is paying tax under the default tax regime. Then, he cannot avail of deduction under section 24B for the interest on borrowed capital in respect of self-occupied property. Here, Ganesh can opt any of the two. He can treat any of the two properties as self-occupied. Then, for such two properties, he cannot claim 24B deduction. Since the net annual value of any self-occupied property is nil, he cannot claim standard deduction under section 24A. And deduction under section 24B is not allowed under the default tax regime. So, the properties which Mr. Ganesh treats as self-occupied properties fetch neither income nor any loss. Hence, income from such properties is nil. If we look at the table below, there are three houses, house number 1, 2, 3, and here there are three options for Ganesh. In the first option, he is treating house property 1 and 2 as self-occupied. In such case, the income from house property 1 and 2 will be nil. And income from house property 3, if it is let out, it will be 73,640. Under default tax regime, if the house property is let out, the assessee can claim deduction under section 24B. So since the house property 3 has for the purchase of house property 3, Mr. Ganesh has acquired loan and he is paying interest of rupees 1,75,000. He has paid interest of rupees 1,75,000. So we can claim such amount as deduction under section 24B. After claiming deduction under section 24B, the income from house property 3 will be rupees 73,640. Similarly, the second option is where the house property number 2 and 3 are self-occupied. So we are taking the values, the incomes from house property 2 and 3 as nil. The income from house property 1 will be, which is deemed to be let out property, is rupees 2,19,800. The option number 3 is where the house property 1 and 3 are self-occupied. So their incomes will be nil. And the income of house property 2 will be rupees 1,76,840. Here the interest on borrowed capital is rupees 55,000. Generally, if the property is let out, there is no ceiling limit on the interest on borrowed capital. Hence, there is no restriction of 30,000 for the let out property. There is no ceiling limit of 30,000 for the let out property. In case of self-occupied property, under optional tax regime, there is a ceiling limit for interest on borrowed capital for the purpose of RRR, which is rupees 30,000. Here we can claim the whole amount of 55,000 since the property is let out property and it is default tax regime. Even under the optional tax regime, the assessee can claim the deduction of 55,000 if it is let out property. So there is no ceiling limit for interest on borrowed capital for let out properties or deemed let out properties. Here, if we consider all the options, since option number 1 is most beneficial, where the house property 1 and 2 are self-occupied and house property 3 is deemed to be let out property, his income from the house property would be rupees 73,640 for the assessment year 2024-25 under the default tax regime under section 115 BSC. Here in question it has been given that we have to assess the we have to choose the house which should be opted by Ganesh to be treated as deemed to be let out property and the other two will be self-occupied properties so that his tax liability will be minimum. Out of these three options, the income from house property is less when the house property 3 is considered is deemed to be let out property and house property 1 and 2 are treated as self-occupied properties. So if Mr. Ganesh has opted for default tax regime, he has to it is beneficial for him to choose the option number 1 where the house properties 1 and 2 are self-occupied and house property 3 is deemed let out property. If Mr. Ganesh has exercised the option of shifting out of the default tax regime, that is, he is paying tax as per the normal provisions of the Act. In such a case, the interest on borrowed capital under section 24B is allowable as deduction. So, when the house property 1 and 2 are considered to be self-occupied, for house property number 1, the GAV will be nil, NAV is nil and he cannot claim deduction under section 24A, the standard deduction, and there is no borrowed capital for house property number 1. So automatically, if house property 1 is self-occupied under the optional tax regime, the income from such house property will be nil. Considering the second property, if such property is treated as self-occupied property, The computation will be same till the net annual value. We can provide the standard deduction of 30% on NAV. But the interest on borrowed capital has a ceiling limit of 30,000 only. Mr. Ganesh cannot claim rupees 55,000 as the interest on borrowed capital. He has to claim only 30,000. The NAV, the house property 2 is self-occupied. The NAV will be nil. The section 24A deduction cannot be claimed when the NAV is nil. And interest on borrowed capital is restricted to only rupees 30,000. So, the loss from house property will be incurred as rupees 30,000. The loss from house property 2 is 30,000 because of the interest on borrowed capital for repairs, which is actually the actual amount is rupees 55,000, but there is a ceiling limit for self-occupied property under the optional tax regime of rupees 30,000 only. Now, the house property 3 is treated as deemed to be let out property. Then the computation will be same and the income from house property will be 73,640. The income from house property is 73,640 and loss from house property 2 rupees 30,000. If we set off these amounts, the total income from the head house property under option 1 will be rupees 43,640. Considering option number 2, where the house number 2 and 3 are self-occupied. In such a case, for house number 1, we can take the amount income from house property rupees 2,19,800 as the income from house property, as it is deemed to be let out property. We have made this computation assuming that each of the house properties here are deemed to, are let out properties. So directly we can take rupees 2,19,800 as income from house property number 1. For house property number 2, if it is self-occupied, NAV is nil, we cannot claim deduction under section 24A, and interest on borrowed capital will be restricted to 30,000 just as in the previous option. So only, the loss from such a house property will be, house property 2 will be rupees 30,000 minus rupees 30,000. If the house property 3 is also self-occupied, NAV will be nil. There will be no deduction under section 24A and the interest on borrowed capital is rupees 1,75,000. So, the income from house property 1 is 2,19,800, loss from house property 2 will be 30,000 and loss from house property 3 will be 1,75,000, which is interest on restricted to rupees 2 lakh only. Since the amount is less than 2 lakh, we are taking the whole interest on borrowed capital as deduction under section 24B. If we set off these amounts, the total income from the house property under option 2 will be rupees 19,800. Under the option 3, house property 1 and 3 are self-occupied. Then we can directly take this amount income from house property rupees 1,76,840 from the house property number 2, since it is deemed to be let out property, and for house property 1, since NAV is nil, there will be no standard deduction and there is no interest on borrowed capital. So the income from house property 1 will be nil. If house property 3 is self-occupied, in such a case NAV is nil, we cannot claim deduction as standard deduction, and deduction under section 24B is rupees 1,75,000. It is since it is less than rupees 2 lakh, the whole amount is claimed as deduction under section 24B. Here after setting off these amounts, we are getting the income from the head house property as rupees 1,840 under option 3. Since option 3, out of these 3, option 3 is beneficial. There is a mistake in the material. Sorry for the mistake. Since option 3 is most beneficial in this case, Ganesh should opt to treat house number 1 and 3 as self-occupied and house number 2 is deemed to be let out. His income from the house property would be rupees 1,840 for the assessment year 2024-25 under the optional tax regime. That is the normal provisions of the Act. Here, option 3, where the house property 1 and 3 are self-occupied and house property 2 is deemed to be let out property. In such option, Ganesh is getting the income from the head house property as rupees 1,840 only. It is much more beneficial to pay tax as per the option number 3 under the normal provisions of the Act. So if he is paying tax under default tax regime, he will go for option number 1, where 1 and 2 are self-occupied. If he is paying tax as per normal provisions of the Income Tax Act, then he will go for option 3, where 1 and 3 house properties are self-occupied. With this illustration, let us conclude our chapter Income from House Properties. I have not covered all the illustrations which have been given in the institute material, but all the concepts, important concepts, have been covered in these illustrations. There are few miscellaneous problems let out. One is regarding the unrealized rent, where even when the rent has been received, the rent has been realized after years, we will be treating it as the income from the house property in such year, and 30% standard deduction will be provided for such unrealized rent which has been realized now. There is one more illustration where the house property of resident individual is situated outside India, and for such house property we will generally take the annual value as per the local laws of that country, and from such gross annual value we will deduct municipal taxes which have been paid in such country to arrive at the net annual value. That is one more problem. And there is one problem relating to the interest on borrowed capital. Here I have added one more point. For the self-occupied property under the optional tax scheme, the maximum amount of deduction under section 24B an assessee can claim for acquisition, construction and repair, renewal, reconstruction shall not exceed rupees 2 lakh for self-occupied property under optional tax scheme. Here I want to convey you guys that if there is an assessee who has borrowed loan for the purpose of acquisition or construction, and in the same year he has also borrowed loan for the purpose of repair, renewal or reconstruction, in such a case the maximum amount he can claim under the optional tax scheme for the self-occupied property will be 2 lakh for acquisition and construction, 30,000 for RRR. But this 2 lakh and this 30,000 is also having an upper ceiling limit of rupees 2 lakh, that is under section 24B. Be it for acquisition or construction or be it for repair, renewal or reconstruction, the maximum amount an assessee can claim for self-occupied property under optional tax scheme will not exceed rupees 2 lakh. The maximum amount that can be claimed under section 24B will be rupees 2 lakh only. This is a small clarity I want to give you guys. So, hoping you have enjoyed this lecture. Thank you.